It's Tuesday, 17th of September, and this is your Capital Economics Weekly Briefing. I'm David Wilder. It's an extra show this week to focus on some interesting things happening in commercial real estate. We did one of these a few months back. It had such a great response. We thought it was worth going again, particularly given the issue that we're going to be talking about. I've got Kiran Raichura, our chief CRE economist and US lead, and Matt Pointon, who heads our UK CRE coverage with me. And the topic is retail's recovery. If you've been too busy reading the obituaries about physical retail, then you may well have missed the fact that the sector has turned a corner. Kiran and Matt are now advising clients on the opportunities within retail, and they're going to walk us through how this sector has emerged from its long dark night of the soul, but also how much upside investors can expect. Hi, Kiran. Hi, Matt.
Hi, David.
Hi.
Kiran, let's start with you. You've got a new report out which says it's time to go shopping for retail. Why now? What's changed within the sector?
Thanks, David. So for us, we think the retail sector, as you highlighted, has reached a bottom and is on the recovery phase. It's had this tough period where there have been a number of factors weighing on it. So in the report, we highlight three that have had a really major effect. So that's the growth of e-commerce, this kind of story about oversupply in US retail, and then also the pandemic. And where we are now is that we feel like we're coming through all of those challenges to some extent. So if you take e-commerce, for example, we're starting to see e-commerce firms that are previously online only open stores, so Amazon, Allbirds, Warby Parker in the US, and then also previously physical store retailers are also making use of their existing store networks to cut delivery costs and the cost of returns, which are quite substantial for online retailers. So there's kind of two directions impacting on the e-commerce story there. So as far as the pandemic goes, we've also seen recovery. So footfall this year in the first half of the year was finally back above 2019 levels. And so combined, those demand side improvements have meant that the number of new stores opened has increased substantially in recent years. So particularly in 2022, space was being leased up exceptionally quickly, and we've seen further recovery in 2023. The average time to lease retail space dropped to 8.5 months last year, which was its quickest in 20 years. So that is really a big step change. And then I also mentioned oversupply previously. Demolitions have been pretty strong in the last few years, running at around 50 to 60% of all retail completions. And also those completions numbers anyway have been pretty low. And there haven't been many mall completions in particular, which has been probably the worst hit part of the sector. So, brought together, that means that we've seen and expect to continue to see vacancy drop back and, like I say, continue to decline further. And that's replicated in what we see in REIT earnings reports, where they're talking about occupancy rising above 95%, rent growth on the same store basis rising to 3% or even higher. So a pretty strong turnaround in the occupier market for the retail sector.
Okay, but I mean, the big caveat here, I guess, is that there are recoveries and there are recoveries. This isn't, you mentioned 20 years ago. This isn't 20 years ago, right? By historical standards, what kind of strength are you expecting to see in where retail goes from here?
So that's an important qualifier. We don't think that retail returns or rent growth will reach the same kind of heady heights it saw in the early noughties, where it was the strongest performing sector for most of the first 5 or 6 years of the century. But on a relative basis, it does look pretty good. So it is stronger than it has been in the last 10 or 15 years. And if you think about it in relation to other sectors, for us, it now looks like the second strongest performer over the next 4 or 5 years. And actually, we had been talking about it being the strongest performer for the last couple of years on a 5-year basis. But as we kind of go into those 5 years, and it's weathered the downturn pretty well, it's now likely to see that. But further ahead, the 5-year view will be more that comes second to the multifamily sector.
What about within the sector? You talked about store openings. You also mentioned that there hasn't been any new mall construction. I wanted to highlight just one example. Macy's, the management of Macy's recently outlined plans to shut around a third of its namesake stores by early 2027. What's the significance of that, thinking about Macy's as sort of these anchor stores within US shopping malls?
Yeah, so one of the challenges that the sector has faced, and we saw it especially in the pandemic, was when department stores that anchor those malls close, there are often terms for other retailers in their leases that they can close their stores while breaking a lease without incurring any penalties. So one thing that's different in the US to some of the European markets is that, when those department anchors leave, then you can see essentially the death of a mall, which we don't really tend to see in the same way in other markets. So as far as Macy's goes, that has potentially a downside impact on the mall space. And certainly if you think about the different subsectors within retail, then malls are where we still see the greatest risks, and actually we're forecasting the lowest returns over the forecast period. On the flip side, where we see the most strength is in power centres. So there we think those benefit from their access for the consumers, because they're near their homes, they can drive there very easily, and so the extent of remote work we're seeing means that people are more likely to use those. And they're also well tuned to click and collect services, which means that people can order things, go and pick them up, and kind of get in and out very quickly. And that sector also benefits well from its high income returns, which means that over the forecast period, that's actually our top performing retail subsector.
I want to go back to what you're saying about the recovery strength and how it compares to the early noughties. But to bring in this question about the US macro outlook, Capital Economics, we're not forecasting a US recession, but our US macro team is looking at a slowing economy, a cooling jobs market. How does all of this affect the outlook for retail?
In terms of the baseline, it definitely weighs on the demand outlook. So one of the stories is that, we have seen this slowdown in new retailer openings. Brokers have referred to that as being about a lack of space in some instances. But I think it's quite reasonable to expect that some of that is also about either the existing slowdown we've seen in the consumer sector or concerns about what that might look like over the next 6 to 12 months. It is also worth saying, though, that, as far as if there were to be a recession goes, clearly the retail sector would be impacted through that mechanism of weaker consumer spending. But actually, it wouldn't be the worst affected sector in our view. We did some work previously when there was threat of a US recession over a year ago, and it was the apartment sector that came out as the sector that would be most impacted because there's a more direct link there between unemployment and the ability to pay rent, essentially. So the bigger impact would be on apartments there, but certainly retail would be affected to a similar extent as we'd expect to see in office and industrial.
Matt, I'd like to bring you in at this point. The broad story that Kiran's talking about, recovery in US retail, slowing economy notwithstanding, are we seeing a similar story play out in the UK? Are you giving our clients looking at UK assets a similar sorts of advice? There's obviously been no end of casualties on UK high streets. Are we seeing an end to that adjustment process?
Yeah, so the UK story is pretty similar to the US story. It's been a torrid few years for the retail sector. Capital values have dropped about 40% since the end of 2015. And within that, some aspects have done even worse. Shopping centres, capital values are down around 60%. So it's been a pretty bad period. But the very fact those values have dropped so far, I think now presents an opportunity. Shopping centre yields are now over 10%. I mean, that could represent a buying opportunity for some investors. In terms of the economic outlook, again, we do have a recovery. We are forecast for GDP are slightly above consensus. It's not going to be a very strong recovery overall, but within that, we think consumption will do a bit better as the cost of living crisis, sort of fades. We've got lower inflation, we've got lower interest rates, and we think that will help boost consumer spending. At the same time, if you look within consumer spending, obviously consumers have a choice of what they buy. We think retail goods sales are actually going to benefit disproportionately over the next few years. Consumers are still coming out of this cost of living crisis. They are still cautious. And I think they will look towards, increasing their spending on lower cost goods rather than higher cost leisure services. It's, the so-called lipstick effect. So I think the outlook consumer spending in the UK a bit better. Couple that with the good values you're seeing in the sector, I think, will help drive returns. It's not going to be a booming recovery, but it will be a recovery in retail. So just putting some numbers on it, retail also has the benefit of being a relatively high income sector. So even though our rental forecasts aren't that out of line with the rest of the market, total returns for the sector are actually pretty good. at around 8% per annum over the next 4 to 5 years for all retail. That's above the all property average, in line with industrial and second only to the residential sector. And within the retail sector, again, retail warehouses will continue to outperform. We think total returns there will come in at just under 9% over the next 5 years.
What do you make of these proposals to pedestrianise Oxford Street in London? It's an idea that's been kicking around for years, but it seems to be back in the headlines today with London Mayor Sadiq Khan making another push on this. For those unfamiliar, Oxford Street used to be the shopping destination in the UK capital. It's been in decline for years, in large part because of the factors that you and Kiran have been talking about. So what do these proposals signal about Oxford Street's future, but also about UK retail's adjustment more generally?
Well, it's obviously good news for Oxford Street. I think retailers, they've been adjusting to online competition for many years now. You've seen, sort of out-of-town retail parks, as Kiran mentioned, have adjusted more easily. You can, as you said, you can do click and collect. That's driving footfall to some of these retail parks. You've got good parking, so it's easy to get to. High streets, their key advantage, I think, is more the retail experience. It's a nice place to go. It's central London, for example. You can do a bit of sightseeing at the same time. But to really capitalize on that, you've got to make it a nicer experience, and pedestrianization of these streets is, of course, one way to go to try and improve that overall retail experience. You might have a store, you might not get many sales there, but you might just need people to go and physically look at things. Consumers still want to do that. And if you improve that experience, you can drive some footfall to your stores. You maybe get the sale online, but you still need the store there to drive that footfall, drive your brand recognition, for example.
Kiran, can we come back to you? Because I wanted to end by asking about how what's happening in retail compares with the office sector. Offices have been decimated by the pandemic and this cultural shift to working from home, and they're also going through this painful structural adjustment. You and Matt have both spoken about retail's adjustment. And as an outsider, it does seem to me like a similar process to what's been happening with retail, that offices are going through this decimation in values, working through this issue of oversupply as this structural forces take hold. So is this comparable? Is it a comparable story in terms of offices versus retail? And if so, what does it tell us about the timing of offices recovery? I guess, in other words, when are you going to be telling clients that it's time to go shopping for offices?
That's a good question. So we actually did some work on this last year. I think you're right to draw parallels. Clearly, both have been affected by structural change in behaviours. The big difference really is that the office change has been almost overnight. There was a period in 2020 where we're working from home and then suddenly it became the norm. With retail, there's been this kind of gradual impact since the early 2000s where it's taking an increasing share of retail sales. So in terms of the impact on demand for space, the kind of story is quite similar. I think you could probably make an argument that the office story, certainly at this point, has probably had a bigger impact on office demand, or certainly will when we see more leases expire and more kind of physical move-outs happen. In terms of how long that adjustment will take, so retail, as far as values go, it's been going for about 8 years. For offices, we think we're still partway through the process, really, and we've been talking previously about values bottoming out in the next couple of years, but really the impact on demand is going to play out much further. So we think that could still be taking place through towards the end of the decade. And we've previously written about values not reaching their previous peaks until the 2040s. So there's a long drawn out recovery in terms of asset prices reaching their previous pre-pandemic levels for offices. And the same is true for retail in terms of it being a long, slow recovery back to those levels. So we definitely would be talking about a fairly long period of recovery for people who are kind of sitting on those assets and wondering when they're going to be back at 2019 levels.
Okay, thanks Matt, thanks Kiran Raichura and Matt Pointon there on retail's revival. I will add their relevant research to the show notes. Do check out their full CRE analysis on our website, capitaleconomics.com. This show will be back on Monday with our weekly look at the world of global macro and markets, including a review of the Fed's September meeting, but also what the Bank of England did and how markets are reacting to these policy pivots. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.